The smartest money on Wall Street is doing something they've never done before. Warren Buffett is sitting on $325 billion in cash. Jamie Dimon just sold JP Morgan stock for the first time in his career as CEO. Bank executives across America are quietly liquidating their positions while telling you everything is fine. And here's what should terrify you about 2025. The crash everyone predicted for this year isn't happening on schedule, but that's not because the problems disappeared. It's because they've gotten exponentially worse while being systematically hidden from public view. Right now, as markets hit new highs and economists declare victory over recession fears, the largest financial institutions in America are sitting on time bombs that make 2008 look like a practice round. We're not talking about subprime mortgages this time. We're talking about $2.3 trillion in shadow banking exposures that don't appear on any balance sheet. We're talking about $957 billion in commercial real estate loans maturing this year that can't be refinanced. We're talking about a system so interconnected and leveraged that when it breaks, it won't crack gradually like 2008. It will shatter instantly. The delay isn't mercy. It's the setup for something far worse. And the people running these institutions know exactly what's coming because they're positioning for it right now while keeping you in the dark. Let me show you what they don't want you to see. The first thing you need to understand is that every major financial crisis follows the same pattern. There's always a period of false calm right before the storm hits. In 1929, the market reached record highs just months before Black Thursday. In 2007, banks were reporting record profits while packaging toxic mortgages. And in 2025, we're watching the exact same playbook unfold in real time. JP Morgan maintains its baseline view that the current economic cycle will not end in 2025. They're forecasting only moderate recession risk over the next 12 months. Bank of America echoes this optimism. Goldman Sachs talks about a soft landing. The Federal Reserve suggests they've successfully navigated the most aggressive interest rate hiking cycle in 4 decades without breaking anything important. But here's what they're not telling you. While these institutions project stability publicly, their internal actions tell a completely different story. US GDP growth has stalled at just 1.5%, down from 2.7% in 2024. Interest rates are falling, which sounds good until you realize this is hammering bank profit margins. Net interest margins are projected to contract to approximately 3% by December, the lowest levels since the financial crisis. And while official sources maintain cautious optimism, respected economists are sounding alarms that mainstream media refuses to acknowledge. Nouriel Roubini, who correctly predicted the 2008 crisis, estimates an 80% chance of recession by the end of 2025. Torsten Slok from Apollo puts those odds even higher at 90%. These aren't fringe voices. These are economists with track records of accuracy when it matters most. The disconnect between official projections and expert warnings reflects something far more dangerous than simple disagreement about economic data. It reflects a coordinated effort to maintain confidence while the foundation crumbles beneath our feet. Now let me show you what's really happening behind the scenes, starting with the shadow banking system that's grown into a monster nobody wants to acknowledge. When the Dodd-Frank Act was implemented after 2008, the stated goal was preventing another financial crisis by regulating banks more strictly. What actually happened was that risk didn't disappear. It moved into the shadows, into a parallel financial system that operates with even less oversight than the banks that nearly destroyed the economy 15 years ago. Today, shadow banking represents $68 trillion in assets globally. That's nearly 3 times the size of the entire US economy. And here's the terrifying part. Traditional banks haven't reduced their risk by avoiding these markets. They've amplified their risk by becoming the primary funders of shadow banking operations. Moody's reports that US banks have lent approximately $300 billion directly to private credit providers. But that's just the beginning. Total lending to all non-depository financial institutions has surged to $1.2 trillion. Banks' credit commitments to non-bank financial institutions reached $2.1 trillion in the third quarter of 2024 at large banks alone. Think about what this means. Banks are taking on credit risk through complex intermediary structures that obscure the true nature and extent of their exposures. They're essentially lending to lenders who are lending to borrowers that the original banks would never touch directly. It's a shell game designed to circumvent regulations while multiplying systemic risk. The interconnected nature of these relationships creates amplification mechanisms that weren't present during previous financial crises. When stress hits one part of the system, it doesn't stay contained. It spreads through these hidden networks like wildfire through a forest that's been soaked in gasoline. US banks now have large and growing exposures to subprime corporate and consumer credit through both direct and indirect channels. They're extending $2.3 trillion in credit commitments to shadow banks, in addition to their direct loans to businesses and consumers. This represents hidden leverage that could explode when economic conditions deteriorate, forcing banks to recognize massive losses they've successfully kept off their balance sheets. The diversity and growing involvement of non-bank entities in credit provision has led to more interconnections, including on a cross-border basis. The IMF notes that stress in this sector can now be transmitted more widely to other parts of the financial system and to the broader economy. But here's the critical point. The opacity of these connections remains significant. Even regulators don't fully understand how deep these relationships go or how quickly contagion could spread. This isn't theoretical risk, this is mathematical certainty. When the inevitable stress test comes, these hidden exposures will surface all at once, creating a cascade of failures that will make 2008 look contained by comparison. But shadow banking is just one part of the equation. The most immediate and quantifiable threat to banking stability in 2025 comes from a sector that everyone can see, but nobody wants to discuss honestly. Commercial real estate. The numbers here are staggering and undeniable. $957 billion in commercial real estate loans are maturing in 2025. That's nearly triple the 20-year average. This refinancing wall is hitting at the worst possible time in modern financial history. Since the Federal Reserve began raising interest rates in the first quarter of 2022, commercial property values have fallen 22%. Meanwhile, borrowing costs have increased dramatically. The mathematics of refinancing have become brutal for property owners. A hypothetical $100 million office building would decline to $72 million if cap rates increased from 4.5% to 6.25%. If the borrower wanted to refinance at this lower valuation, they would need to contribute an additional $18 million in equity just to get the refinancing approved. According to the National Bureau of Economic Research, approximately 14% of all commercial real estate loans and 44% of loans on office buildings appear to be in negative equity positions. This means the debt exceeds the property value, dramatically increasing the risk that borrowers won't repay and will default on their loans. The exposure isn't evenly distributed across the banking system. Regional banks are disproportionately vulnerable. Commercial real estate loans account for 28.7% of assets at small banks compared with just 6.5% at bigger banks. Regional and community banks hold roughly 70% of commercial real estate debt, creating concentrated risk in institutions that lack the diversification and capital buffers of their larger counterparts. Many smaller banks have commercial real estate loans representing 40 to 50% of their total assets. This concentration risk creates the conditions for a cascade of bank failures if commercial real estate defaults accelerate as expected. Banks have been employing extend and pretend strategies, temporarily extending loans to avoid recognizing losses. But this approach has limits. The temporary postponement of recognition rather than resolution of underlying problems is creating the conditions for an even more severe crisis when the inevitable reckoning arrives. What makes this commercial real estate crisis particularly dangerous is how it mirrors the Silicon Valley Bank collapse, but on a scale that could dwarf anything we witnessed in 2023. Remember, Silicon Valley Bank failed not because of loan defaults, but because of interest rate risk and concentrated exposures. The bank held long-term securities that lost value when rates rose rapidly. When depositors panicked and tried to withdraw funds, the bank was forced to sell these securities at massive losses. Now imagine that scenario playing out across hundreds of regional banks simultaneously, all holding underwater commercial real estate loans that can't be refinanced. The Federal Deposit Insurance Corporation is already seeing warning signs. Banks are reporting increased charge-offs on commercial real estate loans. Delinquency rates are climbing steadily, and the worst is yet to come because most of these loans haven't reached their maturity dates yet. The extend and pretend strategy that banks are currently using creates a false sense of security. By extending loan terms temporarily, banks avoid recognizing immediate losses on their balance sheets. But this approach doesn't solve the underlying problem. It simply delays the day of reckoning while making the eventual impact more severe. When these commercial real estate loans finally mature and can't be refinanced, property owners will face a simple choice: inject massive amounts of additional equity to keep their properties, or walk away and hand the keys to the lender. For many properties, especially office buildings in major metropolitan areas, the economics favor walking away. Brookfield Asset Management, one of the world's largest real estate owners, has already started this process. In 2024, they defaulted on 2 Los Angeles office towers, simply stopping payments and giving the buildings to the lender. This wasn't because Brookfield was in financial trouble, it was because those specific buildings were worth less than their mortgages, making default the economically rational choice. This trend will accelerate throughout 2025 and 2026 as more loans mature. When it does, the lenders holding those mortgages will realize massive losses. And those lenders are primarily the regional banks that Main Street America depends on for business lending, consumer loans, and basic banking services. But here's where the story gets even more disturbing. The commercial real estate crisis and shadow banking exposures aren't separate problems. They're interconnected in ways that create feedback loops and amplification effects that could trigger systemic collapse. Private credit funds, which are part of the shadow banking system, have become major players in commercial real estate lending. When commercial real estate values collapse, these funds will face massive losses, but these are the same funds that traditional banks have been lending billions to. When the private credit funds can't repay their bank loans because their commercial real estate investments have gone bad, the losses cascade back to the traditional banking system. Meanwhile, insurance companies and pension funds have invested heavily in both commercial real estate and private credit strategies. When both sectors collapse simultaneously, these institutions will face liquidity crises that force them to sell other assets, creating downward pressure across all financial markets. The interconnectedness extends beyond direct financial relationships. Banks, insurance companies, and shadow banking entities often have shared investor bases, common asset exposures, and correlated trading strategies. During periods of stress, these relationships create contagion effects that spread panic faster than any individual institution can respond. This dynamic played out during the 2008 financial crisis, but the current system is far more complex and interconnected than anything that existed 15 years ago. The shadow banking system has grown exponentially, the commercial real estate market has become more leveraged and speculative, and the regulatory framework designed to prevent another crisis has simply pushed risk into areas where oversight is even weaker. The result is a financial system that appears stable on the surface, but is actually more fragile than at any point in modern history. The delay in the predicted 2025 crash isn't evidence that the problems have been solved. It's evidence that the problems have been hidden so effectively that when they finally surface, the impact will be immediate and devastating. And the people who understand this best are the ones running these institutions. That's why Warren Buffett is holding record amounts of cash. That's why bank executives are selling their own stock. That's why smart money is positioning for collapse while telling everyone else that everything is fine. They know what's coming because they can see the data that isn't being shared with the public. They understand how these systems are interconnected because they're the ones who built the connections, and they're preparing for the inevitable while ensuring that ordinary investors and depositors remain completely unprepared. The question isn't whether this system will collapse. The question is when and how severe the damage will be when it does. Based on the mathematical realities of shadow banking exposures, commercial real estate refinancing pressures, and systemic interconnectedness, the collapse won't be gradual. It will be sudden, severe, and unlike anything we've experienced in modern financial history. The delay is giving the smart money time to position perfectly for what comes next. While everyone else believes the crisis has been averted, they're building the foundation for generational wealth transfer on a scale that will reshape American finance forever. The signs are everywhere if you know how to read them. While banks project confidence and markets hit new highs, the smartest money in America is quietly positioning for the collapse they know is inevitable. Warren Buffett didn't accumulate $325 billion in cash because he believes in the stability of current markets. Bank executives aren't selling their own stock because they think their institutions are undervalued. They're preparing for what the mathematics make undeniable. The 2025 crash isn't delayed because the problems disappeared. It's delayed because the problems have been systematically hidden in shadow banking exposures, extend and pretend strategies, and interconnected webs of risk that make 2008 look simple by comparison. When this system breaks, it won't crack gradually. It will shatter all at once, and the people who saw it coming will be the only ones positioned to survive and profit from the chaos. The choice is yours. You can believe the official narrative that everything is under control, or you can follow the money and see what the people with the most to lose are actually doing. The delay isn't mercy, it's your final warning. And the clock is running out faster than anyone wants to admit.